Well, good morning, folks. Long time no see. How's everybody doing? I'm checking Twitter. I prompted those that follow me on Twitter to give me a 5x5 if the chart and my audio is good and if the volume's good for you. Let me know. As soon as I get a 5x5 from any of you, I'll know I'm good to go. Thank you, folks. Thank you. All right, so I may require I gotta be careful here. It looks like the volume is a little too loud. It goes into the red. So I'll have to talk like I normally do. So it should be fine. Anyway, we have a few things that we're going to cover this morning. And if it is your first time here watching a live stream from me, usually when I do a live stream, I'll go in, I'll look at live price action, and depending upon how I deliver, how long I go this morning, I don't think I have a whole lot of time for the teaching part of it and the review. It'll just depend on what we do at the opening, and we'll see if we can look at some live price action. No promises, but we'll see what we see. It's important for you to keep up with the ICT Mentorship 2023 playlist. So anything that I put up, whether it be a live stream like this or another lecture, I add it to the 2023 Mentorship playlist on my YouTube channel. If you're new, okay, and I'll get this out of the way here, some short housekeeping. If you're brand new to my channel and you want to know where to go in and start, my advice is to go into the 2022 ICT Mentorship playlist. It's 41 videos. The first video, you really don't need to watch that one. But for completeness sake, to say you watched it, the first one kind of like sets the tone for what you're trying to or should be expecting. If you have never seen anything from my content, if you really don't know how to read price action, and you really just want to get down to the brass tacks, because I am long-winded, because I want to give you value, and if I'm going to teach something, I want to get the highest form of understanding communicated to those individuals that want to learn. If you're short attention span, or if you are not really interested in knowing everything about why you would be incurring risk or taking on risk, if anything less than that, then you're really setting yourself up for failure. So if a teacher or an educator is making themselves available, it's important that their passion is behind that education, because your results are a direct reflection on my ability to communicate the logic. And I want to convey as much detail as possible, instead of just saying, this is what a buy signal looks like, this is what a sell signal looks like, and then give you a static screenshot of this is what it looks like all the time. It doesn't look like that all the time. There's like subtle little variances in the way price action is delivered. And it's important for you, especially for someone that's new, okay, or if you only refer to price action through a retail perspective. And when I say we don't trade retail, or we don't follow retail logic, we're not looking at the things that permeates this industry, which is collective in all the books, courses, and regurgitated. So that's what makes my content sometimes a little overwhelming or overcomplicated, because you're trying to form fit the things that you think you know into what it is I'm teaching. And my challenge has always been, don't believe what I said or say about it. Go into your charts and see if what it is I'm saying is there or not. I'm confident if you do the due diligence to do that, you will find it. Okay, so if you're new and you want to, like a study program, I tweeted this the other day on my Twitter account, but the best, shortest cut, right to the point, pardon me, is the 2022 playlist. That is a model that I designed for my daughter. My heart went into it. I wanted to make it streamlined. I wanted to present something that was time-based. That way it removes a lot of the when does it form, when would I look for a setup, and I don't know what session to trade. I don't know, should I trade London? Should I trade New York? That pattern of looking for that run on liquidity, a shift in market structure, and then going into a fair value gap, that can be traded in Forex. It can be traded in futures contracts, index futures, currency futures. I have students, I don't trade crypto, but I have students that swear by their results being in crypto. I don't trade synthetic things. Okay, so I know I get a lot of questions from the folks in Africa. I don't trade the volatility index. Okay, so I don't do anything crypto. But that model is something that you can go right into the marketplace and start studying and seeing it. And watching other students when they share their examples or results with me on Twitter, many times you're seeing that very model form. And that model is, in my opinion, and I may be incorrect in this, but I'm assuming a great deal here, and give me the liberty to do this because I'm going by what I'm seeing in feedback. A lot of the funded companies are coming forward and basically stating that the majority of their profitable payouts are coming from my student base. So that's a testimony in itself. What are they using? What was the thing that bridged that gap between not really knowing what they're doing and going in and finding money, finding profitability, finding consistency? I believe, and the ones I've interviewed, the ones that reached out to me, it's the 2022 model. And I have charter members that have paid me to learn one-on-one, not in the sense that they're sitting right next to me, but this is what I did with them every day. I would sit down, I'd go through the charts, and I'd explain to them what they would expect to see in the price action. And I'm in the high 90% of accuracy. And it's been like that for years in the witness of thousands of people. Now there's hundreds of thousands of people that are publicly watching this stuff happen. And that model can be used on intraday charts. It could be used on higher time frame charts. And I've been beat up lately with a lot of requests for coming off of the lower intraday charts. A lot of you don't want to trade or can't trade those 1 and 5 minute charts. I understand that. But I also include, and as I'm including it right here, that same approach to using those shorter time frame charts. The only reason why I'm doing that is because it affords me lots of examples so that we can see there's consistency, and using the logic, you can find continuity in your analysis, and therefore results could be expected to pretty much be, routine or business-like. If you go to your job, you're not changing what you're doing every single day. You're doing the same monotonous tasks all the time. And as a trader, that's what you're trying to do. You want it to be boring and monotonous. And the best way I can communicate it was that 2022 model. I couldn't make another model simpler than that. And it's working. It's working in the hands of other people. And even for people that just started following me last year, they got funded and they're getting payouts and they're doing well. Some of them are trading their actual live money. In my personal opinion, and this is my personal opinion, this is not to discourage any of you, I don't think you should be trading in your first year. There's a lot of things you're going to learn about yourself. And there's a lot of things about price action that you have to learn as well. But that can't be appreciated if you just go and watch a couple videos and then say, well, let me see if it works with my account, and then risk real money or risk, not being successful with a combine or a challenge from a funded, prop firm or whatever. So just go slow. I promise you, the folks that are doing very well, they put a lot of work into this before they did it. And I'm talking about the six-figure earners. The guy just did $300,000 in 3 months. Another guy, Jade, he's killing $500,000. Okay, folks, this isn't Mickey Mouse money. Okay, that's real money. It's not demo. These guys are killing it. Paladin, killing it. I have lots of other people that are getting ready to come forward as well that are just smashing it in their own accounts, not doing prop funded accounts. Take your time. Nothing's going to change, okay? The algorithms are going to change. They're not going to turn it around because ICT has told too many people about it. The markets have always booked like this. And the only thing that's going to change in the future is it's going to be much more efficient. So it'll be less of the choppy consolidation because there'll be a lot more people involved. Therefore, the liquidity increases. So it's not a disadvantage to you or a reason for you to be concerned about more people growing in our community using my content. It's literally going to make more liquidity for efficiency, we're not going to be the buy, stop, read, then reversal. We capitalize on that retail mindset. My approach to trading and teaching you is that we harvest liquidity. We hunt it. It's prey. Retail logic, things like moving average crossovers and things like that, there's a place for that. It does make money. You can make money flipping a quarter, but predominantly there is a large degree of, neophytes that enter the marketplace. And when I first started, and I promise this is the end, we're getting into the teaching, but it's important for you to know where we're going and where you should be in your expectations and learning. But retail-minded traders think that every single time a overbought, oversold oscillator goes oversold, therefore the market should go up, and that's not true. And I learned that lesson hard in my first year first year and a half. I was insisting upon buying oversold conditions all the time, and I didn't understand bear markets. So it can stay oversold for a long time, and you could be buying falling daggers, and it's very painful trying to catch that. And what I have done in my career is try to communicate things that you wouldn't really learn from anyone else and make it into a language that way it's communicated through charts when the things that make these price moves run are not actually in charts. And that sounds like it's an impossible thing. There are things that are occurring outside of the kill zones I talk about. There are trades that occur, but I could never bridge the gap between what I know about what's going on, therefore finding in a chart that is repeating all the time or enough times to make a setup for it. So the things I teach you, like specific PD arrays, a multiplier, when you're looking for a setup, you're looking for, what is your multiplier? Your multiplier is the thing that you use to get in. That's not a model. Okay, it's the multiplier that puts you in a trade, whether it be my order block, whether it be a fair value gap, inversion, or standard. If it's a institutional order flow entry drill, an optimal trade entry, okay, a propulsion block. All these things are specific multipliers, the things that you're looking for in price action. I teach you, I think it's in month 4 of the core content, and forgive me if I'm not being accurate, but I think it's where it is, month 4, where I go through the PD array matrix. Those are, in my opinion, they're the ones that is the easiest for me to communicate using a time-based chart. Now, I have other PD arrays that are not requiring a chart. Like, I don't need a chart, but that's so complicated. And some of you complain about what I've already taught as being complicated. I'm not even going to touch that. Like, I don't need to have a chart. I could be driving around in my Corvette, know that at this time, between these 3 minutes, I know it's going to do this. And then I know it's going to go this. And I know that. That's algorithmic. But you're here to learn how to do something that repeats over and over again that you can visually see, that you can trust. And that 2022 model, I promise you, if you study that and spend time with it, in between your practice sessions and back testing, that means going back and looking at chart moves that have happened. It builds this experience base that you require to lean on. I have had a lot of requests for longer term swing trades. So I teach in the core content quarterly shifts. That means like every 2 to 3 months, there is a major intermediate term price swing that takes place on the daily and weekly charts. That is like a macro perspective. So when you sit down, like right now, I'm sitting down for the first time, being away from the charts for a few days. I did some day trading on Friday. I might share some of that with you when we get into ES. But I teach in the Twitter spaces that I do, and also in all the things that I'm rambling about usually in these videos or presentations. If you feel like I am not getting to the point is I'm teaching you how you're going to have to navigate these things. And one of the things I talk about in the realm of psychology is if you're under a lot of stress, not feeling well, had a loss in your family or whatever, it's important not to trade. It's important to stay away from the charts because you're going to be hurting. And that pain, that discomfort, that boredom can even, spur it on. You're going to do something impulsively. So, I've been going through something emotionally with a pet. So I can't focus. So that's why I've spent some time away. She's improving, thank you. But I can't focus when it's like that. And some of you communicate that same type of thing in other facets of your life in Twitter. You're going through a breakup. You've been sick. You just got fired, and then you're wondering why you're not seeing success or consistency in your trading, because you're emotionally charged. So even though my concepts, I believe, are superior, you as the operator, me as the operator, I'm the author of this stuff. And if I am sitting in front of the charts and I'm in a state of mind that is unstable, I'm hurting, I'm emotionally charged, I'm sick, or I'm fatigued if I haven't slept in 2 days. It's usually when I need a nap. And sometimes that happens a lot. So whatever those things are, it's going to be for you that as a barrier or a distraction. Or if you feel an overwhelming desire to want to trade because you feel like you need something to make you feel good or get a high off of it, don't consider my concepts as the silver bullet, quote unquote, to fix that for you. Because you can fail even with these high-end, high-precision elements that I'm teaching you. You as the operator will fail yourself. Just like I would have failed myself if I would have pushed last week and did things that I know I wasn't going to be focusing on. It doesn't mean that the logic is flawed. It doesn't mean that your ability to trade is expired. It just means that you are not firing on all cylinders. That means you're not focused. And you're going to be impulsive. You're going to be reactive. Okay, we don't react to price. We anticipate it. But if you go into the charts with a need to be right, a need to feel better, to feel like you are not worthless because maybe someone broke up with you, those things will channel into, and you'll actually see a setup because you want it to be there versus it being there. So just be mindful that when I'm teaching you, that you have a great deal of responsibility. You have that responsibility, and your success is solely yours. But your failures, you have to own them too. I don't co-sign for either one of them. So with all that preamble and monologue out of the way, let's get into it. I mentioned the last few times we were doing market reviews and analysis, I talked about how let me go over my chart and talking to you with the YouTube studio. It's not going to help me. There we are. So this is the dollar index, and it's shown on a weekly chart. So I mentioned that we would likely reach up into, and we wanted to see it get up into the halfway point of this last up close candle prior to this rotation lower. So this up candle over here, the initial draw was that order block's opening price. That's what's being denoted here. We saw it expand up from that. I told you that this gap here, I wanted to see that treated as an inversion gap, okay, or inversion fair value gap. That's what the IFVG stands for. Now, this is the problem that will arise if you're watching someone that is trying to teach my concepts when they're not even fully taught yet. They would see this gap here, and it runs up, and they'll think, okay, that's a short, because look at these relative equal lows down here. No. There's a logic that has to be applied to it, and a narrative. The fact that we have unfinished business in this order block, there is uncertainty. There's a lot of, there was concern about the U.S. debt ceiling, a potential default, the WAR scenario on the other side of the world. Okay, all these things are causing concern, and that concern is a catalyst for flight to quality or a safe haven. And at the present, the dollar is still considered that, but I think it's waning. Nonetheless, that sends typically the dollar higher and foreign currencies lower. And we're going to talk about Forex tonight too, or today, and not just ES. But I started with the dollar index because the dollar gives me that risk on, risk off scenario. Now, if I believe that the dollar is likely to go higher, I need to know where it's going to likely draw to. I just can't just indiscriminately go out there and think, well, it's going to go up. Let's just see where it goes. Let's just find out. Okay, that to me is myopic. You need to have a specific level, not a zone. Okay, and not a supply or demand zone. There's specific levels that I'm teaching. This last up close candle right here has the low, the opening price, and the mean threshold, which is the halfway point from high to low. That's what those levels are. The last time we talked, I said we would like to see it get up into, and I said we'll see if it wants to get up to the mean threshold of that order block right there. Nothing said we're going short on dollar. I didn't say we're shorting anything in dollar. We were looking for lower prices on euro dollar, and we'll cover euro dollar when we get at the dollar. So in fact, we saw price run up into it last week, and now here we are on the present week. This is this present current weekly candlestick for the dollar index. Did this gap over here act as support? Yes. Intra week, it did it on this week, but then last week it did it as well. Traded down into it, and now we're trading here. So when we get to the lower time frame daily chart, this will be more impactful too. But whenever I give analysis out, whether it be through a tweet or in video, invariably there's this sect of my followers that will say, okay, now what's going to happen? When you should be thinking about what you just watched, and have you broke it down yourself? Have you spent any time in the lower time frames, individual sessions, individual days, over the scope of each individual weekly candle, and see where the setups form with the 2022 model? Because that's what you're supposed to be doing. If you're just waiting for me to put up a new video or talk about something on Twitter, you're really doing yourself a disservice, because a lot of the work, 90% of the work for you succeeding, is done by you. It isn't just by listening to me. Because if it was that easy, everybody that watches my videos would be funded, making money, quitting their jobs, and be rich, and where's all the yachts, right? They don't do the work. And that's why it's offensive sometimes when I tell people, you're not putting in the work. Because what you think the work is many times insignificant. It's not enough. And you have to put real time into it. And what you're doing in that time is spending it in old moves, using the logic and the experience I've shared. I told you that I was wanting the dollar to go higher. That was, go back and listen to the commentaries. It's there. It's not ambiguous. But because I state my opinion, there's a lot more of you publicly that are following me. You sometimes are waited on bated breath just to hear me say something, and you take that and you go out there and you bet real money with it. And that's why I said, don't bet the farm on it. I'm constantly reminding you there's risk. And if you don't know what you're doing, don't be deceived in thinking you think you know what you're doing simply because you watched a few of my videos. It takes time to learn this, and you have to give yourself the time and patience that's needed to do it. So we did in fact see the inversion fair value gap form here, and we're rotated up into daily bearish order block. This right here will be much more easier to see and understand now when we go into a daily chart. Okay, so here's that daily candle. So it looks just like that weekly candle. We have this big old run up here like that. It does not, folks, listen, okay? It does not need to be an engulfing candle. That does not make an order block. Okay, there's so many people out there typing that stuff up in pseudo mentorships things, and like that's not my order block. Okay, the idea of the market rotating after hitting a key level, you take it right to the last candle. That candle does not need to be engulfing anything. That narrative, that's the thing that's missing from these 20-year-olds that run around thinking they know how to do this stuff. And I'm talking to you because I know you're listening. Okay, I'm telling you these things so that way you can improve and not hurt the people that you're trying to fleece. I'm being more responsible with your students than you are. So here's the bearish order block, the opening price. Now, why am I using the opening price versus the low? Whenever there is a short little stubby tail or wick, okay, whenever it's like that, I generally, as a rule of thumb, but not always, but generally, most of the time, I'm going to go right to the opening price. And the reason why I'm doing that, okay, and this is where you write things down, folks. This small little tail on the candle, I know that there's probably something in that lower time frame that I'll be able to use, even if it wants to go outside the realm of the opening price. So I may be able to look at something that may or may not be supportive for a trade in that range. But for a anchoring on a higher time frame basis, I'm anchoring it to the opening price. Now let's assume for a moment that it was a longer tail. In other words, this little segment down here on the candle, say that was longer and the opening was actually somewhere up here. Then I would use the low. And I would use the consequent encroachment of that tail or halfway point of that little wick. So those are the two key levels I would use for a candlestick that has a longer wick. Okay, so there's a little bit more insight about order blocks. And I'm telling you why I'm using the opening price versus the lower high. So have that in your notes and go through your studies, and you'll see that that's a very good general rule to help you. Okay, there will be instances where it does other things. Okay, but I'm not done teaching. But just grow in what I'm sharing now. I'm giving it to you. So we have the weekly order block. We traded up and through it. Hit the daily bearish order block. We traded up into that. Now look at the bodies of these candles. Weekly order block, daily order block. Look at all that encapsulation and price action. The volume of all that trading, the majority of it's being shown in the candlestick bodies. Yes, it expanded, as we would like to see anyway. We're expecting it to go higher. It went above these levels. We don't expect it to stop dead in its tracks when we're bullish. We really want to see it go to it and through it, because the narrative, the expectation we had was the dollar should go higher. And notice that all of the sustained price runs was on the buy side delivery. That means candlesticks that are going up. Infrequent were the down close candles. These are daily candlesticks, by the way. But look how it opened here, traded away from it. Opened, rallied up here, and then traded down. We expanded through and fell short of the main threshold of the weekly order block. And it's important that you annotate your levels. Now I'm showing you how I do this here, and some of you ask all the time, how am I doing that? On TradingView, this is what I have it set up as: middle, center, for it to appear here. And when I'm doing the new week opening gaps, it would just show on the right. So it shows over here. And you'll see the new week opening gap when we get into ES. So we're seeing it dig into these levels, expanding up, reaching. And then finally, once it pierced the mean threshold of the weekly order block at 104.540, then we had a rotation lower. Where did it go back to? That weekly inversion gap, the fair value gap that we anticipated seeing it act as what? Support. Folks, that's narrative. That's not picking both sides of the marketplace. If I'm telling you a specific PD array, that level on that PD array, if it's a range like a fair value gap, it's the high, consequent encroachment, which is the midpoint, and then the low of it. That's not a zone where it's ambiguous. Like, where do you trade a supply and demand zone? Okay, that's why I'm not supply and demand. And I also cut through candles. Supply and demand would not use this level over here based on anything like that, because they say we don't cut through candles. They need a fresh zone. Everything from ICT is fresh, baby. Everything. There's nothing stale here. We always have fresh bread, and my students are always making fresh bread. They do it on their own. They don't ever run out of yeast. Just like this mentor talking to you, I don't ever run out of yeast. You're never going to run out of opportunities. It's never going to happen. There's no reason for you to rush it, because once you get it, nobody can take it from you. Nobody can say you can't do it because they don't like you. They don't like your personality, whatever. You can find these setups. Once you have the understanding, you can go into any market, any time frame, and murder it. Literally murder it. but you're trying to be too quick to assume that everything that you already know will complement what I'm teaching you. No. What I'm teaching you will make the stuff you tried to be profitable with profitable. If you include the things I'm teaching, how to read price, the draw on liquidity, that's the first lesson. The first lesson I start to drive home in a student's mind is, where's the price trying to gravitate to? Where's it trying to get to? Well, initially I started with the order block, the weekly, then the daily, and the mean threshold of that weekly order block. Does your chart show this? Because you're looking at a live chart right now with me in the live stream. Did it pan out like I showed? Absolutely it did. The same direction I was looking for. Everything I was looking for in terms of the specific levels, I gave you the logic. I talked about it beforehand. It's here now. So it wasn't done with a 1 minute chart. It wasn't traded or worked with in a second chart, sub 1 minute time frame. It wasn't even on an hourly chart. I used weekly charts. It works, folks. You can make this work for you. Where you are at in your life, school, business, job, your relationship causes constraints that you can't do the intraday charts. I get it. But don't think that it's a one-trick pony that only works on a 1 minute chart. There's a lot of 1 minute setups that allow me to teach you that there's no short supply of setups. You will always find setups. But there's going to be times when the market will be, well, look at all this mess in here. I don't like these types of periods. I don't like that. And that's why you see me do what? I took time away. I did road trips. Now looking at the price action in hindsight, now it makes perfect sense to you why I was doing what I was doing, right? But at the time you're thinking, oh, they changed the algorithm. ICT's on the run. No, I'm relaxing because I know that all I need to do is see a shift in market structure. What was that? See this high? It breaks it. What does it leave? Fair value gap. See that? Now, we're going to talk about gaps today. My personal private students and the public students, all of you, probably majority of you here, are constantly asking this question. Can you talk about the breakaway gaps? Can you talk about when fair value gaps should not fill? I'm going to teach you about that today. Okay. So if we're looking for a draw on liquidity and we are in this vicinity right here, the first thing we want to draw our attention to was this imbalance here, that shaded area. Now, when I'm showing it to you on a daily chart, and that's the time frame this is being shown in right now for the dollar index, I promise you all of this works in ES. It works in Forex because I'm starting this whole presentation. This is going to be Forex in the beginning, and then I'll end the discussion in today's live stream on the index futures. But everything I'm teaching you here is applicable to Forex and futures and commodities and gold and bonds. We're going to talk about bonds today too. Okay. But all of this higher time frame gives you, in my opinion, you're welcome to disagree. You're never going to convince me otherwise, but the higher time frames is where the majority of your time should be spent, because it's so easy to get lost on these lower time frame charts, especially if you're new, because you'll think you see all kinds of stuff. The Three Stooges pattern, there isn't one, but I'm just making a joke about how everything can be applied to any time frame. If you want it to be there, you'll see it. It's like a mirage. You're thirsty. You want to get that new drink of success. And just like sometimes in a desert, you'll think you see something out there that looks like water, and you get up on it, it's just more sand. And you don't want to fill your well with sand by chasing setups that are not there. They're phantoms. Higher time frame removes most of that. Not all of it, removes most of it. So now let's talk about, and again, before I get into any discussion, I want to take you back to the weekly chart and show you what this is again, this shaded area right here. Real quickly. I like to be complete, folks. I don't like to leave anything up for debate. That little section between this candle here, that low, and this candle's high. And the reason why I'm drawing attention to that is, let me take this away just for a second. Can you see how this candle dropped, stopped? The next candle here opened, traded down all the way here, and came back and stopped. The next week it opened, traded up a little bit, but didn't come back all the way to that candle's low. See that? So there's a distinct gap, separation between those two key levels there. And then we expand lower, and we open, trade up, leaving this little portion of price action between this candle's low and this candle's high remained open. Okay, so it's only dropped down. So that's sell side delivery. What is it inefficient? Buy side. So it's a SIBI. Sell side inefficiency, buy side. Oh, I said that wrong. Sell side imbalance, buy side inefficiency, SIBI. That little distinct gap there stands out. If we were standing over here on the right of all this price action, look how fortified all these back and forth movements are here. All these candles moving back between over and over again inside of this range here. You see how that is back and forth, back and forth, back and forth, back and forth. That is not inefficient at all. That's a lot of back and forth delivery. In other words, think of the analogy I many times use, like a paint being applied with a roller on a wall. In this area, paint has been distributed back and forth, and paint in this analogy would be price. So the range of offering liquidity up and down in that shaded area, there's no inefficiency whatsoever on this time frame. So where does the inefficiency exist? Right there. It only has one roll down, never up until we get over to here. Okay, so that fair value gap there was the draw up, and the context was I want to see it trade up through it and come down and act as support, and that would make it an inversion fair value gap. If I didn't hold that expectation, it would be treated as a standard fair value gap in a premium relative to the high and the low here. That would be a premium fair value gap, and the way you know that is you take the fib anchored on a high down to the low. Here's equilibrium, and the fair value gap exists right there. At equilibrium or above is premium. At equilibrium or below is discount. But I did not say we're looking for lower prices when it got to this fair value gap. I said we want to see it go to it, through it, and come back down and treat it as support. That's an inversion fair value gap. Don't take my word for it here. Go back and look at the other reviews that I've showed here. Go and look at the tweets. Listen to the Twitter spaces. Sometimes I cuss there. Just be mindful that, you know, it's live. Here I try to, I tend to do a better job because I'm looking at candlesticks, but if I don't have a candlestick chart in front of me on Twitter spaces, I generally use blue collar language, and my imbalances inside me just make me not the best mentor for that. But that little gap here is this segment. When we go down to the lower time frame daily chart, now you know what you're looking at. Right there. See, it doesn't look like a gap here because look what it's done. It passes back and forth, okay? Do not assume, this is really important, do not assume that a inefficiency, whether it be a fair value gap that's a buy side imbalance, sell side inefficiency, or a sell side imbalance, buy side inefficiency. Either or. Don't assume if it's on the daily chart that if you see on, or a weekly chart rather, don't think that we see these back and forth moves on the daily chart that now makes this a balanced price range. It doesn't. Because on the weekly time frame, it's inefficient still. The higher time frames have to have bodies hit the floor. That means it's got to cover that gap. Even though these individual daily candles have worked inside that range, that's not, you're seeing the formation of that weekly fair value gap with all of this in here on the daily chart. It's something you have to study on your own, working a higher time frame down to lower time frame. The higher time frames are parent. The lower time frames are subordinate. They're only going to behave in a manner that allows certain price delivery within the context and constructs of a higher time frame imbalance or liquidity pool. That's it. That's the liquidity continuum. What you're looking for. Market has to go up to a premium for what? Only two reasons. It's going up to take the buy stops, or it's going up to some inefficiency, some gap. Markets only go down to go to an inefficiency, a fair value gap below current market price, or it's going down for sell stops. I do not care. This is no disrespect to anybody else out there that teaches and made money. I don't give a flip. The markets don't go up and down because your indicator said so. The market doesn't go up and down because there's momentum of buying and selling pressure. That is not what is going on here. Okay, it's never been that way, but we have been led down the primrose lane with books, authors, teachers, whatever, saying that it's buying and selling pressure. It's not. These markets are absolutely controlled. Period. If we can see the likelihood of price action wanting to at least get up to this level here, why did I use that fair value gap? Remember, I'm painting why I said this was something important. Why did I pick that weekly fair value gap? And why did I want to see it trade through it and become support? Because it's at a level that on a simple run of the daily chart, using this dealing range, this low to that high, remember, I'll add the fib back to it. Folks, this is real learning. This is the point. Okay, the point is you want to know what you're doing. If you want to go out there and gamble your money, go watch somebody else. Okay, you're welcome to do that. But if you want to learn, and you want to learn correctly, you're at the right place. That fib at 50 is halfway or equilibrium relative to this high and this low. So if I'm waiting to see price to try to gravitate to here, I want to see, does it perform what I would really rather see happen? I don't want to see it go up there and then sharply break lower, because if it does that, then I got to drop down to a lower time frame and look for a fair value gap or something else on a short-term premium to sell short, because then it would likely run into these relative equal lows. But my experience in 30 years told me, that all the factors that's going on right now in the world, geopolitically, all the turmoil, all the things that's going on, the economy, all that stuff is a cause for uncertainty. And because of that, I want to see, yes, my PD array is going to be a draw on liquidity. It's going to draw up to that weekly fair value gap. But I already announced to you that I'm going to see this do something other than just go up into it and treat it as an area to sell short from. I want to see it go through it. Does it do so? Yeah. Look where it closed. Above it. I did this stuff real time in live streams where I taught you how to discard or disqualify a fair value gap. So that way, it looks like cherry picking because I'm showing you examples. And a lot of people that hate me or trolls and people can't keep up with me, they'll insist that it's cherry picked. But they don't know the logic. And if they would just simply listen to me now, I'm telling you what I'm doing. So that way you can go back and look at the things I've shared and say, oh, yeah, there it is. There it is. Right. I'm not pulling things out of thin air. I'm pulling it from 30 years of experience. I authored these things. So I'm sharing that language so that way you can learn how to do it. So this fair value gap was the initial draw on liquidity. When we shifted above this high here, that candle right there that runs above that short-term high, that's a shift in market structure. Now market is in a buy program. A buy program is now when you start looking for premium arrays. Where do you look for those premium arrays? Well, what is the dealing range? That is this high to that low. We're only interested in premium. So we don't look at this short-term high as a turtle soup, run above and go lower. We don't look at this high here as a run above that and turtle soup and go short lower. No, we're looking for the first equilibrium or higher PD array. We started on the higher time frame. You want to do a top-down analysis because Large institutions, big funds are going to be using higher time frame charts. So we're going to cannibalize their long-term models. Their long-term model through here was bearish. So we're looking inside the scope of this high to that low right there. Midpoint is here. That shaded area in orange, I'm assuming it's a hue of orange, but that shaded area, that's the weekly inversion fair value gap. That's the first level of my interest. Okay? So this specific weekly point of interest, I gave you the context as to what I want to see with it. It wants to go higher, great. I need to see something specific. I want to see it trade to it and through it. We've seen it close right there. If a market closes above a fair value gap that you think should be bearish, that's not a good shorting opportunity. Many times it's communicating to you that it will become an inversion fair value gap. Oh, there you go. The penny just dropped. I just gave you something again. But if you're not listening, okay, if you're not trying to filter out the buy and sell signals, then you think I'm teaching you in Morse code. I'm teaching you specifics in detail. This is the point. You want to be trading with precision. You want to be able to read the charts without me and nobody else helping you and be independently wealthy. All these things have to have a lot of understanding and logic. So that way you can trust it. It's not changing and morphing all the time. The rules aren't changing. The goalpost is not being moved. You know that this logic is sound. You've seen it many times before and you can trust it. So that way when you go forward and you're in forward testing and then before a combine challenge, or if you're trading with your own account, you'll trust it. You won't be nervous. It's the same type of thing like when you go to work. You know the different routes that you can take to get to work. Is the map changing? Sometimes there's a detour that's required. There's construction. Well, guess what? Sometimes the market will do a little hiccup and you didn't see a specific time frame do something and it might stop you out. Okay. Recalibrate like a GPS. What does it do? It reroutes you. As long as this objective of the weekly order block, which was the draw on liquidity, this was the multiplier, the inversion fair value gap. So I wanted to see, does it get to it and through it? Yes. Does it treat it as support in the lower time frames? It does. And then trades up to that weekly order block, daily order block. And the last level you heard about was we want to see if it wants to get up to that 104.54, which is the weekly bearish order block mean threshold. Now, that's a lot of stuff. There's no way I could say that in less time and teach you what I just talked about. What was going through my mind? Why did I talk about that level right there? That is the shortest, absolute shortest way around getting between point A and point B to the point. That was the logic that I used. Think about how you could have said it with less words and make it make sense. You can't. So stop, okay? Stop expecting something to be condensed when this is condensed. But it's specific, so that way you understand the logic behind it. So now let's go into grading a price swing. So we have these levels here. The first one I drew your attention to was that weekly order block. Now, I could have very easily laid all these out here in advance and said, watch all three of these get hit. But you're learning. Your understanding is a graduated experience. And charter members could go right into this and see it right away. People that have been with me for a very, very long time. If you're new or relatively new, if I lay this level here, and what I'm about to say is not to be construed as talking down to individuals, okay? I'm just reminding you where you're making the mistakes. You are. I'm not making the mistakes. I'm telling you to be careful. But if I say I like this level here, and you foolishly go out there and you try to trade with your money or risk your funded account on it or try to do a combine challenge and insist because ICT said it's going to go up here, between this point here and this point down here, there's lots of room for error. If you don't have a lot of experience or don't know what you're doing or you're impulsive and you chase price, even if you do use a stop loss, you'll get caught up in these retracements that you won't expect or anticipate. And you'll walk away thinking this stuff doesn't work. And then now here we are, it goes right to the levels that I talked about. So between these two price points, with this shift in market structure here, and running up into that weekly bearish order block mean threshold. Again, this level here, right there, let me take the fib off because there's more lines on here that I want to show you. That level here is not anything in this fractal of any importance. It's the weekly chart. It's this one here. The mean threshold. This is the halfway point of this candle, and that's done by like this. You take the fib, drop it on the low to the high, bam, right there, 104.540. That's why that level's there. It's half of that. Now let's drop back down into the daily. So we had a market structure shift here, and right away we have this fair value gap. Now watch, folks. This is not quarters theory, okay? Because you're going to hear somebody come out and say, oh, he's teaching quarter theory. I was doing this stuff before quarters theories was even talked about. This is what grading a price swing allows you. You have to know what? Where's the draw on liquidity? Where is the terminus? The end of the line. Where do you think price is going to go? It doesn't mean that's where it stops ultimately and reverses. Where do you see your setup form? Where's the framework? Where is the dealing range that you're going to work within? That dealing range is always in the past, high to low. We framed the equilibrium price point here, and we're aiming for a premium. Why do we want to see that? Because we want to see it trade into this fair value gap and above it, which would nullify, it would remove any need to anticipate lower prices on dollar. It's signaling to you algorithmically that it is not going to go lower. It in fact wants to go higher. So if we can do that, and we see it does, it closes here, that really increases the opportunity for this fair value gap to be inversion fair value gap. That means it's going to act as a resistance broken turn support, to use retail-minded logic. But this would never be construed as that because it doesn't fit any of the type of thing that you would expect with retail support and resistance. Nor does it meet the criteria for supply and demand. Before you go out there and you wreck yourself in your live trading or whatever, it's important to know these types of rules, because if you are slow in making money and fast in trying to preserve or keep it, those two modes of thought or conducting a daily routine move very, very slow when you're trying to make money, because there's lots of opportunities to do that. Every single day there is. Every single week, every single day, every single session, there's something that you can capitalize on. Every single day. And in fact, specific hours of the day, you can trade 1 hour candles and treat it just like this whole idea that I've shown here on the basis of that weekly candlestick. All this stuff is applicable inside of a 60-minute candle. It all exists there. It's a tiny little universe within that one time frame. You can break these things down smaller and smaller and smaller. But you don't have the experience yet, and you have to give yourself the time to acquire that experience. And once you have it, then it gives you confidence. And you got to be very, very careful once you get that confidence that you know what you're doing, it doesn't evolve into egomaniac, attention whore. Okay? I was always that when I was in 20. When in my 20s, I this kind of stuff made me feel superior to everybody. And I communicated that always. And I don't, even though my stuff is superior, I don't view myself in a manner where I have to go out there and stay and prove it. I don't have to do that anymore. I have students now that are doing it. This price range, okay, that I'm looking forward to if we get this shift in market structure, shift in market structure here on this candle here. At that moment, we have entered a buy program. So we have to go back into this range and anchor it to where we anticipate price going. that draw on liquidity. The initial one was here. This one, I don't believe I mentioned it, but I'm going to say I didn't. But you can see clearly it's anchored on the daily chart. But I did tell you this one here. This is where we want to see if it wants to get up into that. So all of this run here, we could be sitting still, anticipating, not reacting, anticipating a run above that short-term high here. Why am I talking about this high? Man, he finally talked about it. He's finally saying it. I've been screaming at this monitor, Michael, why are you wanting this high? Why didn't you use this high? Why didn't you use that high? Why not that high? Low, lower low, lower low. Okay? We consolidate. All through April and May, I'm outie. See ya. I want the market to show me something. So when I was down in Florida, when I was cruising around in my RV, and I don't live in an RV, goober, I want to see it move out of this range. Okay? Let's, just for a moment, let's ring in the bond market. Okay? If you are on Twitter, I believe it was Twitter. If it wasn't Twitter, either I did a video, short little video commentary on Twitter, or it was mentioned somewhere in my commentary on the YouTube channel, but I know I talked about it. And you'll see the chart right away and remember it, those have watched it. But during this consolidation in here, I want to see it perform a specific way. I want to see it show me something. All through here, I wanted to see the dollar go lower. I expected it to take out that low. But because it was showing an unwillingness to perform or show any willingness to go lower, how did I get to the point where I didn't trust it? Talk about how when we don't want to take a trade, when there's something in the price action that says don't do anything. Okay, let's do that right now. Here we have this low right there. See that little pierce below it right there? Little tiny little short move below that low right there. It can and it could have very easily traded back up to this level and then resumed. If it would have done that, then the dollar really would have been bearish longer term. But because it consolidated, I want to see, does it have confirmation through the bond market? All this consolidation is going to be shown in the bond market. When I go to the daily chart for ZBM2023, which is a symbol that's used for bonds, it's not the month that you should be trading or tracking it now. Its volume has rotated into the September contract, but I'll show you what I mean in a second. To understand how the dollar is likely to perform, I use the bond market. Okay, and right away, some of you that just want to have one market, you want it to be real simple and short and sweet, this is where most of you drop off because you're like, oh, this is complicated. If that's how you feel, folks, don't watch my videos, okay? I promise you, you'll do something, either be successful at what you're doing or you'll hurt yourself, and you'll come back here and you'll learn how the markets really work. But this consolidation in here, I want to see, does it perform in a mirror image of what the bond market is doing? The bond market, ZBM2023, was in a range, okay? And I want to see it go down into a discount. If the bond market goes down in a discount, that would result in the dollar index moving into a premium. Here's that range. Okay, we were in this range, and until this range was given up, until it left this range, dollar wasn't doing anything. Equities were going to range bound. That's why I stayed out, taking RV road trips. I don't care about the price action when it's in here like this. Can I trade that? Absolutely. Can you trade it? Absolutely. But to meet a expectation in the community that's been craving higher time frame charts, swing trading ideas, can you do something off the 1 minute charts? I don't know why he's always talking about the 1 minute charts. The answer, the reason why, is because it gives me lots of teaching examples where I can call it before it happens and it pans out precisely. And that is where you should study. Whether you trade them or not, you should study those lower time frames because you're getting so much experience by using lower time frame charts, because it's not noise like the Goldman Sachs boys will tell you. There's absolutely a rhyme and reason why prices. Listen, is it a different price Okay, is it a different price if you're looking at the bond market, Bitcoin, gold, whatever it is, whatever asset you're looking at? Is price booking at a market price differently if you're looking at it on a daily chart or a 1 minute chart? If you were looking at right now, if you're looking at the bond market right here, this is live. It's not delayed data. Right now, the price is showing at 127 and 12/30 seconds. That's what it's showing right now. If I drop down into a 1 minute chart, look at that. Holy crow. It's the same price. So don't listen to these goobers that'll tell you, there's noise on the lower time frames. You're looking at the same price. Price is doing the same thing in all time frames, but the narrative as to what it's going to do next, is going to be derived from what time frame you're using right now. In layman's terms, I'll say it like this. It's going to behave in a manner that the higher time frame outlines. This is price action on the June contract for bonds. So you can see it's real spotty. Okay. If you use ZB, I'll come back to the daily chart in a second. I just want to make a point. Okay, that's the symbol that's being shown right here, ZBM2023. The M is the futures contract month code for June. All the volume is rotated into now the September contract. So that is going to be the U symbol. Watch how all these little dots become much more smoother. See that? That tells you that all the volume and open interest is now rotated early in the bond market. S&P, the June contract is still favored, but it will be changing here shortly. Now let's go back up to a daily chart for bonds, and I'll tell you what I was doing and what I was thinking. And I got to go to the June contract because that's what was being traded in April and May. Okay, so here's the business on the bonds. We were in this range. I wanted to see this break that range. Oh, he's a breakout artist. I knew it. ICT's a breakout artist. He's a break and retest guy. No, I'm not. No, I'm not. I want to see it leave this. This is market profile. Notice there is no volume bars to the right of my chart. Okay? I don't use that stuff. That to me is Mickey Mouse stuff. If you make money with it, God bless you. Okay? God bless you. Run with that idea. That's not what makes markets go up and down, though. Market profiles, to me, is a schematic. It's a behavior, a graph. Now, if you go into my core content on my YouTube channel, which was premium content, people had to pay money for that. Those lessons are the language that my students had to understand when I was doing, live educations and analysis every day. Every single day I was doing analysis, and I was on the spot every single day, calling every single day what it should perform. Where was this mad rush of people coming out and saying ICT's a fraud, he can't do this stuff, I'm paying him, he didn't call that right? It never happened. If anybody's going to expose me, it would have been those individuals that paid me. You're seeing the testimony again. It's happening in front of you. I'm teaching you the logic. You're getting it right from the source. I needed this range here to leave. I didn't care if it was going to go higher or lower because I didn't know at the time which one to trust. Because remember, on the daily dollar index, I wanted to see that low taken out. That's what I wanted. But I had to submit myself to what price was showing me. It was not willing to go there yet. So I had to take a step back and wait. Wait a minute, man, you're supposed to have 30 years experience. Right. That 30 years experience gave me the insights to say, sit still, bro. Sit down. This dance ain't for you. Sit down. Wait. Let the elephant enter that swimming pool. Think about a children's swimming pool. Okay, a little tiny little swimming pool. If a swimming pool the size of a child would use, if you filled it up with water and an elephant came over and sat down in it, what would happen to the water? It would be displaced, right? It would leave the pool, being replaced with the mass of that elephant. Smart money is like that. In this range here, right here, when we saw it close right there outside that range, that sets the stage for up move in dollar. But I have to wait. I have to wait for something. This is Wednesday, May 17th. Let's go back over to the dollar index. I know I should have charged you money for this. All right, so here is May 17.3. There. Okay. Lo and behold, that's the day that the dollar index is trading inside of its fair value gap right there. Post a shift in market structure. So this high broke to the upside. How can we qualify that as a shift in market structure for the dollar to keep going higher? I just taught you. Are we seeing a mirror image that would constitute a expectation for the bond market to enter a sell program? That means bonds going down, dollar going up. Ooh. We're in a consolidation. We're in uncertainty here. So I have to wait. When this happened, okay, all focus goes to this fair value gap. But now I don't want to see it go up here to go short. Why? All this stuff that's happening in the other side of the world. I'm trying not to use words that will flag my channel because I've had friends that are not even technical traders or dealing with the markets, and they talked about these topics and they lose their channel. So I'm not going there. But just think geopolitical, WAR, all those things, all that uncertainty, the debt ceiling, the potential default, all that stuff was a catalyst from a macro perspective, which is why I didn't believe that fair value gap would be a short. Now, if it would have went up there and started to sell off, like I said, I would use a lower time frame, 4-hour, 1-hour chart, short of a premium like that, and get in sync and then run for these lows here. But the context that I went into and I shared with you was I wanted to see that weekly fair value gap trade above it and come down and treat it as support. Look, this is the daily chart for the dollar index. Look where the bodies on the lower end of that gap, look where the bodies were. Was that not respecting that weekly gap? That's not supply and demand. And that's not support and resistance. This is algorithmic. It's referring back to a level I drew your attention to beforehand. Now, how can I do that? I'm not a time traveler. There's logic there. That means there's something going on in price delivery that is well beyond buying and selling pressure. It's rigged. And there shouldn't be any reason for you to be upset about that. It shouldn't scare you. You should be thankful. You should be thankful that they rigged these markets, because that presents the opportunity that as long as you're in sync with what it's likely to do next, well, guess what? There's a 90% likelihood that new traders will lose their money in the first 90 days or less. That's a statistic. But on the other side of their trades, there are people with lots of experience that know what they're doing. They're the winner of those losing trades that the losing crowd loses to. There's a buyer and seller for every trade. It's a net sum zero game. But the game is rigged. There's no reason for you to be mad about it. Start punching the air. That's the reason why that broker did it to me. The broker didn't do anything to you unless you're trading Forex, because they have individual liquidity pools. When you're trading futures, you're all getting the same price. It's a gentleman's market. Okay. If you want to be a savage, you trade Forex. And when it's wild and it moves around, that's why I left futures, because, in the 2000s, it was wild. We had really big, wide price ranges and 300 pip range days on the regular. Well, that dried up and the market started getting real consolidated. So I went back to what I started with, which is index futures. I don't care if the S&P trades with a 5-handle day. And I said that correctly. I don't care if the S&P traded a 5-handle day. Folks, that's exactly what we were looking at in the 90s. That type of stuff in the early 80s and such, those days, that was like the normal. You didn't have this wild, crazy volatility. It's great, don't get me wrong, but if things got so slow and down to a snail's crawl in pace, that's okay. You can still do all those things in those very small little ranges. It'll just look like what the charts look like now, but the amount of movement will be much, much more condensed. And a lot of you aren't even prepared to trade in a market like that because you're so used and you're baptized in all this high volatility. When Forex shrank up and all the pairs had smaller ranges, social media, it was constant belly aching. Oh man, when's the big days coming? When's it? It's moving, folks. If you can get 10 handles or 10 pips from a price swing, that's good. What's wrong with that? What's wrong with if you just got 5 pips? Who cares if the range is really small? But you have to have your expectation calibrated to what the market profile is right now. That means we're in consolidation. I need to see what? I need to see bonds leave, because bonds will qualify whatever the dollar's going to do. I'm going to do a mirror image of it. So bonds broke lower. That means this is qualified as a break in market structure, and it's shifted higher. Fair value gap right there. Let's play devil's advocate and say for a moment, because this is a daily chart, and this is the dollar index, by the way. So if you're a Forex trader, this is the gold mine that you want to be in. Okay, this is where you want to be mining these things from ICT. The things that you think is boring, other people say it's bullshit. This is the stuff that makes you wealthy. This is the stuff that finds consistency and continuity in trading, longevity. You want to be around for a little while, longer than a couple months. Hopefully. It's this insight. This is the stuff that gets you there. Let's say that you saw this happen after the fact. You were working, you were sleeping, you have a business you're running. Just couldn't be in front of the charts, and you saw afterwards the day closes like this. The very next day, folks, the very next day, what do you think the bias should be for your analysis? Bullish. Reaching for what? That fair value gap. So between the 17th of May until we got to the first objective, which is that weekly order block here on this day here. So from the 17th of May to the 24th of May, that run here to here, that right there is a sell program in euro. That means selling short. That means every day you're going in with a bias to go long in euro. It's also a bias to go long in pound dollar. It's also a long or buy program for Aussie dollar. It's also a long for New Zealand versus the US dollar. It is a short. I just said that wrong. You like that? I made a mistake there. This is where I wish I could go back and edit it. The dollar's going higher, so it's a short in euro dollar, short in pound dollar, short in Aussie dollar, short in New Zealand dollar, because the dollar going higher. Okay, it would be a long in dollar yen. It would be a long in dollar Swiss. Okay, because we're looking at, this is the dollar index. So if it's going higher, that range between here, by this day, it's after the fair value gap right here. Let me put it in the chart. Yes, my obsessive compulsive is flaring right now. It's all right. It just shows you I'm not AI. I made a mistake. All right, let's see. Extend right. Take that off. Okay, so there's your fair value gap. So after that forms, the next day here, until it gets to your premium array, where's the draw on liquidity? Weekly order block. What's the multiplier if you're a swing trader? It needs to find support here. So that sets the stage for your swing trade. But as a day trader, you don't need that. You're in there before that, which is why I don't do swing trades. I'm using the information I'm showing you here between this here, the very next day, and I apologize if you hear my stomach because I'm fasting right now. The idea of expecting higher prices on dollar index every day until it gets this objective first here, that sets the tone for a bias. That gives you your bias, because that bias is derived from the narrative that's being shown with higher time frame weekly and daily charts, also intermarket relationships, the bond market versus the dollar index, and market profiling. So we are in a consolidation. We have a shift in market structure. How do we qualify that? The range that I told you that bonds were in, I said, why is the market consolidating? Go back and look at Twitter. I tweeted it. It's there. The bonds are in a range. Until the bonds leave that range, all markets will be in consolidation, because interest rates is what makes the world go round. And then after that narrative is set, then we can have a bias. So the bias is bullish here for dollar, bullish here. It's even bullish on this day, but not in the scheme that we would expect it to open and then buy it and go up. We're in that range now, that fair value gap. So what we would expect is to consolidate or retrace, and does it support the low end of that range? And look at the body showing you that. That's a signature. That's algorithmic. So as a swing trader, you could use this day here as an entry and then pyramid in here for a run into that using that implied dealing range. An implied dealing range is not a dealing range like this where we have a real high and a real low. Those are actual. We're looking for a price run from this low up to this order block on the weekly chart. Until it does that, that's an implied dealing range. We don't know if it's going there. Anything can happen. A bomb could drop somewhere. Some kind of a hack that hits the markets. I expect that's going to be used in the future, by the way. But that run here, that is a implied dealing range. It has not really manifest yet, but we're seeing with anticipation that that's where the draw on liquidity is. The initial one was here. So now let's go and add our fib to this low. I know this stuff is amazing, and I could talk about this stuff all day long. All right, so right there, from this low to that high, which is the weekly order block, what I'm showing you there is the range. Okay, it's an implied dealing range. If we have that, look at the levels I have here. 75, 50, which is equilibrium, and 25. And then here's the high. The high of the run, which is terminus, at the end of the run, if you're going to use this as your dealing, well, not dealing range, if your implied dealing range, it's where you think it's going to go. So before the candlesticks even form, folks, you could have this in your chart like this. It would look like this right here. Okay, say it's meandering around like this in consolidation, and you just start doing your analysis, and you think, okay, what happens if we were to break lower in the pound? I'm sorry, if we were to break lower in the bond market, then that would give rise to the dollar index. High, low is your dealing range. Weekly fair value gap. Okay, that sets the stage for, if we're going to go higher, I'd like to see us remove this bearish stance that I hold on dollar during this time period. If it goes to here and goes above it and treats it as support, I'm not bearish on dollar. Go back and listen to my reviews. It's there. It wasn't word salad. It was very specific. But because we have this range here, we can take the low up to that weekly order block. Let me take the fib off and show you what you'd be doing. This is what you could do here. I know some of you are brand new or this is the first time you've seen this. Oh, this is hindsight. Go back and look at the reviews, folks. I was talking about all this stuff before it happened. I didn't give you this much of a breakdown, but I'm teaching you how to grade a price swing. How to anticipate where the next setups are going to form before they ever come into the chart. Forget supply and demand. Supply and demand requires the candlesticks or ranges to be in the chart. I'm going to teach you where they will form before they will form. Where do setups form? Show me how to buy and sell, Michael. Where are these PD arrays that work? How does it look in the chart before it gets there? What should I anticipate? How can I trust this stuff? Okay, let's do some time travel. Low to high, that's terminus. We have 25%, 50%, and 75% of the range. We require bonds to do one or the other, go up or go down, and leave that range I showed you on its daily chart. It broke lower. Not yet, but now we have a, let go of that, Michael, good grief. We have a shift in market structure right there. On the bond market, we qualified it with it going lower. It left its range going lower. That's going to give momentum to the upside on longs. Not that that's driving price, but that's setting your mindset in motion for it. We're in a buy program for dollar. So right away, we can anticipate somewhere in here, in this area, there's going to be some kind of accumulation. We consolidate here, and then we run. What does that make that right there? That's a fair value gap, right? Yeah, it's a fair value gap. More specifically, it's a breakaway gap. What is it breaking away from? It's breaking away from this consolidation. It has a shift in market structure. So this is your gap to trade. This is the gap that you use to qualify as a breakaway gap, and then trust it's likely going to draw here, which is why I communicated to you. I said, we want to see this traded to, but I'm more interested in trading it up above it and coming back down and finding it as support, which makes it an inversion fair value gap. Now, I know if you're new, this sounds like a whole lot of stuff. Please just give me an overbought, oversold indicator and a moving average to follow. That's okay. You're not ready for me. That's all that it means. It doesn't mean that you can't learn this. It just means that you're not ready yet. Go watch somebody else. There's lots of other people that will entertain you and tickle your ears. You want to learn how to read the markets and really know what to do? Come back here. 50% equilibrium. Look where that fair value gap forms. Equilibrium. Ooh. What do you think's significant about that 50% level? And why didn't that gap fully close? It's a measuring gap. That fair value gap is a measuring gap. This low, this candle did not come to that candle's high. Uh-oh. We're seeing some context and narrative that just ain't in your books, baby. That means we can anticipate this price run here to be duplicated to the upside. Meaning, let's say we have this low is lower than that low and that low, and relatively equal to that one. We don't need this low here. We want to see the energetic price run. That's this one here. So where does that root price run begin? That low right there. So if we take that and measure it up to the high of that fair value gap, why that? Because that's the highest range. So you want to use that as your base point. Extend it from there. And you're putting it right on that same. I'll show you exactly what I'm doing in a second. Give me 1 second. I'm taking that high of the fair value gap. Here's the low of the fair value gap. I've duplicated that. So we now are seeing a range that's projected to go above this gap, which is why I was saying I want to see it go through it and then treat this gap as support. This was the draw. Now, it does go through it. Here's the upper 25% of it. Okay? It comes back down. Immediate rebalance. 1 day delay. Remember when I talked about immediate rebalance? It's that next day or the very next day after that. Then you'll see the price run. There it is. Goes into the weekly order block. Trades up into the daily order block. And the weekly mean threshold order block. Trades all the way up into those levels. Each one of these targets, okay, you're looking for price to continuously reach for them. You don't want to think that, okay, this is my first objective, and then once it trades there, go try to find some other setup in another market. No, you want to stick with it. Does it continuously keep digging into that? The next level, it does. Okay, the last review I did, I said, okay, this is the level we're looking at next. We want to see if it wants to reach up in that 104.54. It did. Every time it was digging higher, I literally watched people on social media bitch about their long positions in euro failing. This is the reason why it kept going higher. If the dollar's going to go higher, euro is going to fall. It's going to go lower. And then it drops from there down to some random level, which is, let me get this off here. Down close candle. Inside the weekly order block, weekly fair value gap, which is now an inversion fair value gap. This is the treatment of it on the daily chart. It comes down, hits it. Look at the reaction there. Do you think you could have took shorts in euro dollar on that right there in the last 1 to 3 days? Well, let's go over to euro dollar. Finally, get the hell off of the dollar index. Get to something that makes sense. We don't trade the dollar around here, right? So here is the euro dollar. And this is the daily chart. And this is the immediate rebalance right here on euro. And this was the fair value gap I mentioned that we would draw down into up here. We drew down into it. And then we rallied one more time into this up close candle right here. That's a bearish order block. Oh, here we go with the hindsight. Folks, listen. Your surgeon that cut on you and did your surgery, before he got his license, he was cutting on cadavers. That means dead people that can't sue you. So That's hindsight too. He's looking at something that is a safe. He doesn't want to do exploratory surgery on you while you're living and try to do new things. They have to do those things clinically in cadavers, bodies that have been offered to science for research. You need to go through these exercises yourself. Look at price action, study it, not just recently. Go back through all of this stuff here. And that's what backtesting is. It's not going into a Forex tester and testing the thing that's a mock-up forward test without live data. That's a stage you can include, yeah. But when I say backtesting, you're going through old moves and studying it and breaking them down. Like you're really going in there in detail, looking at what it's done, what it didn't do, where you would have been stopped out, and being honest about that. How much risk would have been incurred, not using the best entry. Use the worst potential entry. And does it pan out still? Okay. So here's the fair value gap I told you we would gravitate down to. And let's go back over the last few days here. Here's your order block here on your daily chart. Let's drop into a 60-minute chart. In this high down to that low here, do you see anything that stands out? I'll give you a minute while I get a drink. Well, what did I just teach you about dealing ranges? You break the dealing range down. If we were seeing the dollar trade down into that inversion fair value gap on the daily chart, the inversion fair value gap is based on this weekly chart. That is a discount for the dollar. We could likely see it rally. Dollar rallied. That means that we're likely to see euro dollar sell off. How can we anticipate that? And where would it form? Here's your high down to that low right there. Where's equilibrium? 50%. Right here. In close proximity, what do you see as a PD array? That would be at that level or higher for a premium. Remember, if we want to be short, the highest probability shorts are occurring in premium markets above equilibrium. Continuation pattern or continuation premium for selling short in a bear market, it's been a bear market for a while, you can sell right at the 50 level. But specifically, in a premium, we want to see it get into this range here to here is premium. In that range, between this low and that high, where is the PD array that the first one exists at a premium in that range from this high down to that low? When we retraced higher, went into this area right here, it went to this fair value gap, which is a SIBI, sell side imbalance, buy side inefficiency. So if this is what you saw, congratulations, you did it right. And it trades up into it here. Dollar goes higher because it's on its inversion fair value gap. Euro dollar sells off. This area right in here also is running what? Buy stops. Retail traders see this run here and all this consolidation. They see that as a bull flag. So they're thinking something like this. Euro dollar's been going down for a long time. It must have made a low. And they see this right here as a flag pattern. You see how it's like a big flagpole consolidation. And they think if it can break above this high here, it will duplicate. It'll duplicate that same run. Oops. Once we break the high, they want to see it trade back up in here or something to that effect. And I'm doing it very loosely because bull flags and bear flags are trash. But the logic here is opposed to what a retail-minded trader would see. And it's taking liquidity into account. That means the market went lower, we traded here, and we started to move a little bit here. Nobody in their right mind, keyword, would have trailed their stop loss on shorts to that level right there. But on this move lower, I promise you, every Tom, Dick, and Harry out there that's trading Forex because they're ultra scared. They don't want to get stopped out. They don't want to have their profits erode, and they trail their stop loss too tight. And you know who I'm talking about. You're nodding your head thinking, stop talking about me. There's liquidity above old highs and lows. That's 101 in terms of understanding where markets are going to reach for liquidity. But if you can see that liquidity and pair it with some retail-minded idea that would be opposed to what I'm teaching you. Remember, I'm teaching you how smart money sees price and engages it. I'm teaching what the algorithm does. So the algorithm will deliver price above this high to take into account for buy stops being brought to the marketplace. Those market orders are now buying at the market, which is what smart money will offer shorts to the marketplace at that same time. Where? In what price range? In this fair value gap. Where would be the opposing draw on price? Once it went into here, right above this high here is the buy stop. So it trades there, which is the opposite of what we saw dollar doing. At this moment right here, dollar index, let's see here, right at 2 a.m. on Tuesday, June 6th, okay, 2 a.m., the dollar index was making that low here on the fair value gap. See that? So it's a mirror image. So you're qualifying setups, not just on the basis of you see it in your chart you're trading. You have to use some intermarket relationships that would say the opposite. For instance, if we're trying to go short on euro, you want to see something that would constitute a long in dollar. If you can't really see it in dollar, that's opposed to your cable trade, which is pound dollar, or fiber, which is euro USD, whatever you're trying to do in your Forex pair, it needs to be in a setup that would be opposing in the dollar. If it's a Forex pair that has a currency other than the dollar in the first of its name. If we see this setup here that's potentially long for dollar, which is we're trading in that fair value gap, if we're expecting prices to go high for dollar, we would look for pairs that begin with US dollar in their name, like dollar yen, dollar Swissy. Those pairs would mirror what dollar index is doing, which is go higher. But because the dollar is likely to go higher here, and euro dollar being inversely related to it, it's going to go lower. But it's not randomly just going to some level and starting some, mystery as to why it was going to go lower. It's what I'm teaching you. This range, the algorithm refers back to it. So it only needs to go up to equilibrium slightly higher. So we measure that with the 50 level. That's the only thing I'm using the Fibonacci for. I'm not using Fibonacci for entries. I'm using Fibonacci for premium and discount range, delineating a specific range to know where a setup should likely form. But in that range, what range specifically? It's this. There. Somewhere in that portion of this price leg lower, I'm going to look for a premium array. Well, which ones exist? We have the fair value gap here. Man, I should have charged money. Good grief. This I could have made easily $100,000 on this. I'm being facetious, folks. Relax. So that's the first one. That's your first premium array. Using month 4's lessons on the PD array matrix. So what's the next one? Are all down closed candles, back and forth price action. So all of this right here, this is balanced. We've had lots of up and down movement in here. And then we go back to the high. So we have an order block, which is the last up closed candle with the highest close. So it would be the opening price that would be delineated there. Why would it need to go there? It doesn't. Because it's shielded by all of this up and down movement. There's no inefficiency. None. Zero. So what PD array do you use? That one. Which did the market use? That one. What time of day did it occur? London kill zone. 2 o'clock in the morning. That's what I teach you. What's the opposing draw on liquidity? Okay, say you got this much right. How do I know where price is going to go to next, Michael? Because that's what you're all wondering whenever I tell you something's going to happen. I say, okay, here it is, folks. You know, it panned out. Invariably, folks will come out and say, all right, what's next? They're wanting me to get it wrong. they want me to get it wrong so they can say, ha ha! You had 9,000 times in the recent that you got it right. But look what you just did. You missed on this one, buddy. Ha ha, you're a fraud, scammer. You can't win with some people. But if you're looking at that as liquidity here, okay, and we're at equilibrium or higher, that means we are truly overbought. There's no indicator required to see that. You don't need to put a Williams percent R up. You don't need to put a stochastic up. You don't need a CCI. You don't need a MACD. You don't need any of that stuff. This chart is only showing you ranges being measured, which is what the fib is, and then looking for inefficiencies or liquidity. And I draw that out on the chart so that way you can see it. It gives you like a visual eye candy that your attention is focused at a specific area on a chart. And then I go and I talk about what that is so that way you can see it and understand how to use it going forward. So at this moment right here, if in fact the market does go higher, to take the buy stops here and just trade into a short-term premium, which is relative to this dealing range high and that low, hopefully you guys can see this run from this high down to that low prior to that retracement. This is a significant price swing. Like, I'm not looking at like this little thing here to here. That I'm not concerned about that. I want to focus on intermediate term price runs. Regardless of whatever time frame I'm looking at, my eye goes to specifics in price action. I'm not just taking every little micro price swing. I'm looking at from here to here. Maybe from here to here, but from here to here, absolutely. And whenever I see these ranges on the weekend or in the morning, I'll go through my charts before the kill zones or before the sessions begin. And I'm doing this with all the ranges that are salient, which is daily, 4 hour, and hourly, and 15-minute. So I'm looking at all the potential dealing ranges that the market may refer back to. And then I weigh out whether or not, like I just did with this price run here from high to low, how many PD arrays are there? See, you think because I've taught you the propulsion block, fair value gap, institutional order flow entry drill, bearish order block, vacuum block, all those things, you're thinking, okay, which one do I use? Here's a perfect example. Which occurred in that price run? Just the fair value gap. That's all. And it only needed to go up to this level here at the same time it went down to its fair value gap on the dollar. Dollar went down to a discount. It's bullish. Euro went up to a premium. Bearish. Time of day, 2 o'clock. What's the candle here? What's the time? It's always local time, New York. Your trading view chart should always be set to New York. That's the time that the algorithm runs on. I don't care what anybody else says. Okay? This is the way it's coded. So it reports on time, on duty, at 2 o'clock in the morning. After hitting this, then price is allowed to run. Higher, 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 higher. Then at 2 o'clock, off to the races. Boom. What's it going to reach for? How do I target a run like that? Where does it go to next? Well, if it went up to the buy side, here, and it went into inefficiency, here, it's in a premium above 50%, and the dollar's looking to go higher, it's in a short-term discount, it's in a fair value gap. Nothing says the dollar topped. I don't try to pick top.